All right, thank you very much for joining us on another Learn It Live session. Tonight it'll just be me, so just Thomas Atkinson here to go over everything. Unfortunately, Tyrone couldn't make it, but he'll be here for the next one in May. So tonight we're going to be covering how to fix your trading mistakes with multiple time frame analysis. So this is a really important one. A lot of people, and I think I did as well when we first began, we started and we just looked at a few like really low time frames, 1 minute, 5 minute maybe, but we weren't looking at the bigger picture. So we're going to talk about a couple of strategies when things may look different on different time frames and how to avoid losses. And as I think we'll all agree, cutting out losses from even a profitable trading system can make it even more profitable. So let's take a look at multi-time frame analysis tonight and we'll get started. As always, I've got a risk warning, so I'll just read out the first sentence and leave this on the screen. So the information provided here has been produced by third parties and does not reflect the opinion of Pepperstone. The information has been provided without any alteration or verification. So what we're going to be covering tonight, we're going to be covering what multiple time frame analysis is and why professional traders use it to find hidden opportunities. We're going to be taking a look at how to switch between time frames and not get overwhelmed. That's a really big one, especially using different types of charts. It's going to be something that we're going to cover a lot. And then we're going to look at which are the best time frames to use and how to combine short and long term time frames to enhance your trading convictions. So this is when we talk about things like trends or even patterns that we're seeing on larger time frames, and then being able to scalp those time frames or scalp in the lower time frames when we've recognized maybe something that we can have conviction for and how that can augment or help our trading. And then of course, as always, we'll cover off some Q&A at the end. So Josh will get your questions during this. So if you do have any questions along the way, feel free to ask them in the chat and then I'll answer them in about 5 or 10 minutes near the end. So always appreciate that and we love questions. So let's take a look at some examples of multiple time frames and how things look. Here we've got an example of a 4-hour candle and then we've got a daily candle. And you can see how the 4-hour candle, well, this is what makes up this daily candle, looks very different. So straight away, you might be saying, oh, well, of course, that's how it is. But then when we look at this second slide, what you'll notice is sometimes things can look even more different. So here's a 15-minute candle and then there's a 4-hour candle. And I'm not sure how many people in the room know what this is, but this is actually a shooting star candle, and it's very, very, very bearish signal. And actually, this can be used in a lot of strategies, these kind of shooting star or hammer candles, to be quite successful. So if you're looking at a 15-minute, you might notice this is potentially the start of a downtrend or the end of an uptrend, the start of a downtrend, potentially. But when you go to the 4-hour time frame, and then you see a candle like this, you definitely want to be looking more to the short side. So very, very important to always check relevant time frames around the time frame that you're thinking of trading. And what we like to do is we apply a strategy where we say, okay, if we're looking at a 4-hour time frame, we definitely want to check the time frame below it, which is the 1 hour, and we definitely want to check the time frame above it, which is the daily. And what we'll do is we'll usually grab the trend on the above time frame, and then we'll use that to give us a conviction for our trading on the 4-hour, and then we'll usually use the 1 hour for our entry. So if that makes sense. So basically we might be looking at the 4-hour, we'll find what we're looking for, we'll find the break we're looking for, those kind of things. We'll use our convictions from the daily, and then we'll use the 1 hour to help us get maybe more precise entries. And this is where, as a trader, you change your trading system over time. What you'll do is you'll slowly refine the trading system, and you'll be able to say, okay, well, maybe at the beginning, you just take the 4-hour entries, and then later, as you learn more things about the multi-time frame analysis, maybe you'll notice how to add a points-based system onto the 1 hour and get that slightly more razor-sharp entry. So definitely multi-time frame analysis, incredibly important. But here's just an example of how a 15-minute candle chart and a 4-hour candle chart can look very, very different. So what I like to talk to you guys about is the top-down approach. So we start with the highest time frame you're looking at, and you work down, and you recognize the trend or range-bound market. We're going to go into the live chart in a minute, and we're going to take a look at some examples in the past of this top-down approach. Now, another thing that a lot of people don't do is they don't use things outside of candle charts. I know I was definitely a big culprit of this. What I did when I first started trading was I only looked at candle charts. In fact, I was very big on just looking for candle patterns, and I thought candle charts were the only charts that made sense. In actual fact, if you went to Goldman Sachs, JP Morgan, any of those really big guys, a lot of them in the stock world, they actually use lines and bars, if not even more than candle charts. And the reason why this is because they're looking more for the trends. And actually trends on bars and line charts are easier to spot because it cleans up everything, and especially lines, because they're the close of each time frame. So line charts, really, really underused. We'll look at them in a second, maybe look at the Australian dollar, US dollar, and pound US dollar to see how it can clean up a chart and help us with our technical analysis. Another thing we always need to say is stick to and follow your trading system rules. It's very, very important. Obviously, we harp on about it. We talk about it every time. Tyrone and I always go on about this, but treat trading like a business. Because until you treat it like a business, you really won't have success. And that's because you're not taking it seriously enough. This is your money, this is real money. And in business, you usually treat things very, very seriously. So you should treat your trading the same. And then of course, the ability to manage trades. I think that comes hand in hand with sticking to and following your trading system rules like a business. So let's now jump in and take a look at the market right now, and also in the past. So here we've got Euro US dollar daily, probably one of my favorite charts in terms of dailies. I love dailies. A lot of people in the industry use daily charts, so it's a great place to start if you're a new trader or you're looking at even just helping out maybe your 4-hour swing trading systems. And we'll change the chart to a line chart. The reason we do this is because when we go out to different time frames, let's say we go out quickly to a monthly, what you'll notice is that this is a very clean chart. You can very easily see where the highs are. I'll zoom that in a bit so everyone can see it. You can very easily see where the highs are. You can very easily see where the lows are of all time. So a lot of people don't ever look at these charts and they don't realize that this is where the currencies have actually ranged over a long period of time. And of course, where we're at right now is almost smack bang in the middle of the Euro's range over the last 2 decades. So it's very important to know this, because then what you'll notice is when you're drawing your support resistance lines, all of a sudden you've got some serious support that's actually been formed over the last couple of years, here in 2010 and here in 2012, that now is potentially becoming resistance on the euro. So that's why we're seeing this consolidation on the euro right now in the smaller time frames. So never discount the monthly. Even if you're a 1 hour or 15-minute trader, it's always important to know or notice these very long-term, I guess, lines. Like even things like these highs here, you'll notice that over time it's actually been coming down on this angle. And if we switch back over to candle or bar charts, what you'll notice is this has been a very respected point, just like it's being respected right now. So these things are what you're going to very quickly recognize when you go on those monthly or weekly and you just put that line chart down. So go back to the line chart. So here we are in the biggest time frame. Let's jump over to the weekly and take a look there. So here's where I like to kind of switch around my lines a little bit, because they're not going to be exact from the weekly. Oh, better go on the line chart actually. And here we'll notice previously, back in 2015, 2016, look at these resistance points, such strong resistance points on the euro until it broke it last year. We've also got very clear support lines on this weekly. So imagine if we were looking at this from a trader's perspective and we were trading even a 1 hour or 4 hour, would we really want to be shorting the position down here when it's coming into weekly support? Probably not. Would we really want to be buying it here until we see a clean break? Probably not. So this gives us a big range for us to have conviction with on our smaller time frame. So we know that if we were selling here and price hit here, maybe we want to take some of the profit off the table or all of the profit off the table. I hope that makes sense to a lot of people, because this is what really changed our trading. When we started looking at these bigger time frames, it was a huge mistake that we were making for probably 4 or 5 years. We just discounted the weekly and monthly and even daily because we were trading the scalping smaller time frames. So here we've got a very clean picture of what's happened. We've got our ranges, we've got our significant resistance and supports. Imagine if we'd recognize that down here, very big one, and we've now got our resistance over here. So we jump down to the daily. And you can see why I can call it the top-down approach, because I'm going from the top down to the lower time frames. And again, on the daily, pretty clear what was happening here. And we can see that consolidation that's coming through over this side. We can see that this was resistance, it's broken through. And then at this point, when we're on the daily, then we can start to switch over to the bar or the candle. But you'll notice the bar and the candle look pretty different when we're zoomed out like this. And why we do that is because now we want to start recognizing, are there any potential candle patterns, or are there any bar patterns or anything like that that we could be interested in as a trader. So here again, looking at our consolidation, got our resistance kind of line here. And what you'll notice about this consolidation is it's very much in a trading range. So if we go to the candle now, what you'll notice is there's just no closes above this line. There just isn't on the daily. So if there is a close, and let's say it does break past these new highs and closes above, what do we think is going to happen on this particular currency, on the euro US dollar? Well, logically, if we then broke it all down and had a look at what's happening recently, I think we'd all have to be in agreement that at least on the weekly and the daily, and probably even the 4 hour, this is in an uptrend. So the euro US dollar is actually in an uptrend. So if it did break to a new high, what do we think is going to happen to it? It's going to probably gravitate to the next point of resistance, which could be as high as, if we're looking at this weekly, potentially over into these zones. Now, this is going to take a long time. This is not something where we're going to like leave it in there for months or years or anything like that, because that's not what we're necessarily looking for. But it's going to give us an idea of this area that's being broken is very critical. And when it's critical, we know that often when it breaks with momentum, it breaks with speed, and that's very interesting. My guess, these kind of things usually only break off economic news. So you're probably going to see some form of economic news that's going to change sentiment, and then of course it's going to go higher. So we're down on that daily. We've started now breaking down the daily to the candles, and we are starting to come up with a couple of different, I guess, ideas about our trade, and we're coming up with some plans and systems to do with our trade. So this is what we use. These are the kind of systems we use, and what you need to do is build this into your overall strategy. So you just get that conviction, and then once you've got that conviction, then you can have your maybe range-bound strategy and trading strategy and use those along with your conviction. It's quite a powerful tool. Let's grab on to another quick currency here. Similar thing happening with the pound. If we go to the weekly on the pound and do that approach, what we'll know is since the Brexit on the weekly, even if we go to a line here, it's very clear that when it broke past this low, which was at 1.4, look what happened. That was an all-time low for a very long time. I mean, these charts go all the way back with Pepperstone to 1996. So, you know, they go back a very long period of time. And this was clearly an outlier point. So this was definitely a very interesting kind of period, just like when the pound was up here, which seems a long time ago, which was at 2.09 to the US dollar. So logically, if we look at currencies, generally they like to hold in their kind of midpoint. So where's the midpoint? Somewhere around here. So if we have our extreme low and our extreme high, the differences between those somewhere around here. So that's actually logically where you would expect the currencies to like to trade long-term if the economy is semi-stable. Another thing, because we've drawn our support line here, we know that this was going to be a very hard point for the pound to break, and it did. So if we had longs coming into this point, maybe we'd like to take some profit at this area. So just weekly, monthlies, a lot of people underestimate their use. So if we jump down into the daily again, switch over to a candle chart, we can also see things like this was clearly a very big range bound kind of zone. I think I've spoken about it before. When it broke through, this is a change of sentiment. So if we're looking at this on a daily and we're 4-hour traders, when it breaks through this resistance, what we should be doing is we should stop looking for short positions and we should start looking on the smaller time frames, the 4-hour, 1 hour, for long positions. So specifically, if I saw it break past here, and let's say it went up like it did here, I'd then be looking for pullbacks into this roll reversal zone. So this is where the resistance becomes the support. And this would be a very good buy opportunity for me if I was looking for maybe a 3 to 5 day trade, maybe even a bit longer. So these kind of don't always come up, but when they do come up, you then have your conviction that there should be a buyer's market, possibly into the next point up here, which is going to be the biggest issue as we saw on the weekly charts. So it's just a different way of looking at things, and I think that it really helps people when they start to look at these big time frames, because we need to think, where is the big money? And the biggest money in trading is with the investment bankers and the big traders like that. They're the ones that trade the billions of dollars. Us as retail traders, what we're doing is not really that important because we're usually the least informed traders. So if you follow a lot of those things like sentiment traders, you'll often see sentiment traders for us as the retail traders usually don't work that well. And unfortunately, that's because we're often making the mistakes that every single person makes, like counter trending these trades, these trends here. We do all of these kind of things. And then from those mistakes, because we can't recognize them, basically they profit off our loss in terms of the big guys do. Because we all do the same thing. I did the same thing when we first started. And that's why even during that Brexit, when the Brexit happened, which was over here, when that did happen, I remember a lot of people were calling me saying, oh, should I buy the pound? Should I buy the pound? Should I buy the pound? Obviously, I didn't give them any advice on that, but I did say, you know, think of it logically. If it's had a shock like this, usually things take time, and that could be about 12 to 18 months later before they start to see any recovery. And that's exactly the same kind of thing that we saw happen here on the pound. So if we go with the pound US dollar, you know, the time that took to actually recover back to basically where the initial Brexit shock was around a year, and the time it's taken to get all the way back is around 18 months. So really good rule of thumb, if you're in a recession or you're in something like that, often these shocks that are caused in the markets, around 12 to 18 months it takes to recover, if it is going to recover. So it's just interesting to look at things like that. So, all right, let's jump back into the slides and take a look at some more multi-time frame analysis. So here we have a weekly, and of course, what do things look like? It looks like a shorting market or a market that's going down. Then we can see here on the daily, still looks like it's going down, but we've got some consolidation in this bottom right-hand corner. And we've got the 4-hour, and the 4-hour looks very different. So we can see on this daily, we've got that consolidation down here, which potentially could be the end of the downtrend and potentially the start of consolidation or an uptrend. And then on this 4-hour, it's very clear. We've got clear support through the lows here and a clear resistance through the highs here. So if this broke and went on further, that could definitely be an opportunity very similar to what we saw in that pound US dollar, where it could go long and go up over time if it broke through there. And then on the 1-hour, same kind of thing. Strong support here, strong resistance through here. If it breaks, what we might be looking for on the 4-hour, if it breaks, then we can go down to the 1-hour and basically look at that roll reversal to potentially pick it to the upside. Or if it broke past these support levels, we could be looking for the short side or to sell this particular currency pair. So what we really gain from multi-time frame analysis is that it helps us recognize market conditions. So I think we've had a look at a couple of opportunities there where we saw the weekly and the monthly helping us get an idea of how long we might want to be in trades, and also the general consensus of the market and where it most likely is going to go to next. So then we can also figure out whether the market is channeling, kind of like that previous example, where you've got 2 touches to each side. So what I mean by that is you've got a touch to the bottom, touch to the top, another touch to the bottom and touch to the top. And by doing that, we've successfully recognized a channel or a channeling market or range-bound market. And then, of course, we want to figure out what is the market doing? Is the market trending? And I think if you have a look at stock markets, let's say the US 500, if recently it's gone down, but if you bet against that or said that the US 500 was going to go short over the last couple of years, and I do know some people that have done that, they definitely aren't very happy right now. So with things like the stock markets, they are usually inherently going up. And of course, if we trade the indexes with Pepperstone, the upside is always usually a little bit statistically more likely than the downside because of the way that the indexes work. But if we shorted against that market, you have to usually have some really good reasons to do so because you are going against the overall trend, and that trend was up and still probably is up for at least the time being. So let's jump back into the charts and take a look at gold for a second. So I want to apply the same kind of strategy to gold. I want to look at it on a line chart initially, and I want to look through the previous history to see if I can get any clues to what might happen with gold in the future. So I think we've got a clear resistance point up here where gold hit that 1800 an ounce famously back in 2011. And then we've got obviously the low that was formed right just above 1,000, about 1,050 I think it was, which happened in, I think it was 2015. Yeah, it was 2015. Yeah, 15. So the low happened there. And of course, now we're seeing a form of recovery in the gold as a lot of people are nervous about things that are going on in the world, and that's fair enough. So we've done the multi-time frame on the monthly. We can also see this is a very key point, and this was the previous support that got broken back in 2013. So then we jump on the weekly and we stay in the line chart because I think it's really helpful. And what we'll notice is that this resistance point, or this point here, has been very, very important to gold recently. And gold hasn't been able to break past it, it looks like. So if we now go down to the daily and we take a look at it, and we just readjust our lines a little bit, zoom out a little bit to make sure it's still correct, we can see this is a very clear point of resistance for gold. So then what we've got to do is we've got to decide, well, if gold does move above this zone, where do we think it's potentially going to go next? And where we think it's going to go next probably is somewhere up into this zone, because it's very clear space. Look what happened in the past. In the past, when it broke through, consolidated for a bit, went up to this zone, obviously kept going, broke support. When it broke that support, came down to this point, bounced back, consolidated here, and now what we're seeing is a lot of resistance at this point here, which may be broken, and then of course it'll go up. So by doing a multi-time frame analysis, we can look at gold, we can see what's happening on the charts, we can see that this looks like a really giant ascending triangle, and then we can start to make some decisions about how we might trade this in the smaller time frames. So on something like the 4-hour chart, what we'd be looking for is we'd be looking for a clear break of the above point here, and then maybe we'd be looking at potential longs. And if it came back down into our support line here, which is along that trend line, maybe we could be looking for potential longs as well. And if it broke this line, then we could be looking for, potentially short. So what I mean by that is if it came down here, then it came back up, let's say, as most markets will, and then it broke through here, this kind of break could be considered the break of this potential uptrend here, and this would be where you'd be looking for things like shorts. So recognizing those market opportunities on the different time frames is really, really important. And this is, remember, doing it all before you even attach things like indicators, before you even put your moving averages on the system. And I think one thing that Tyrone and I always talk about is that we always talk about using as many tools as you can to get into your trades. There's no real one system that just works. It's about bringing together a series of ideas, just like our video on Fibonacci, just like our other videos, where we've said these are all good things that we've found to be successful and we know are used in the greater trading circles, but they don't just use one, they use multiple things. So even when, if you, let's say, are a MACD trader on this multiple time frame, if you had MACD on all of these multiple time frames, sometimes if you're flicking up and down through them, so let's say you trade the 4 hours, if you're looking at the 1 hour, 4 hour, and daily potentially, so those three, then you would probably leave your MACD on the charts, and maybe you'd recognize something that would potentially keep you out of that bad trade or keep you out of making a poor decision. Or you might actually notice something where it's going to actually help you, and you're going to say, okay, well, this actually gives me added confidence. And one thing with trading is that even if we get it correct and we say, okay, it's broken past here, and you get in it at this point here, so just that little point there, what often happens is on the pullback here, you start to get scared of your system, or you get scared of the trade, and you weren't prepared for it. And by being not prepared for it, you might take the trade early, or you might not let it run, or once it comes back up to this high, you take it off, and you really limit your potential of being able to hold a trade in for a very long period of time. Now, I've actually bought, I've put a trade in to show you, or a trade that was, very big success for me a couple of years ago, to show you how you've got to have that conviction that you're usually finding on these different multiple time frames, and then you use that conviction along with the smaller time frames to help you stay in the trade. So if we jump over to the US dollar yen, it's probably one of my favorite trades of all time. What you'll notice is that if we're looking at this on a bar chart, there was a point in time over here back in 2013 where we had an incredible pennant formation here. So it looks like a symmetrical triangle to a lot of people. This is an incredible pennant, and you've got a really nice pole for that pennant. So the cool thing about these kind of strategies is that once you recognize something like this, and you're doing the multi-time frame analysis, what can we see on the multi-time frame analysis? This was a resistance point back here in 2007, so it potentially could be a resistance point again, yeah? Just like this was a clear support level. And what do you know? Last year, sorry, it'll be a year and a half ago now, when the yen came down to the 100 or the parity, it found a lot of support. So we're looking at those bigger time frames, we're finding a couple of different areas that are very key, and then we can make biases off that. So with this particular pennant trade, I recognized this, and I took the length of the pole, and you'll notice from the break to the length of the pole, look what it's saying that the market should go to, which is exactly the highs. And then what I did was I basically said, okay, well, I'm only going to take 80% of what I think it's going to do. And this is a very long-term trade. So this is one that took a long time to work out. So this is one that basically took 52 weeks. And a lot of people are going to say that's crazy, but it is. It's a long-term trade. It's not what we always do, but it's definitely something that was there. Because I was so sure with my conviction, and because I was really happy with the break and even happy with the consolidation because my stop was under here, with this trade, I actually held it for around 30 weeks with nothing much happening. And that's because I had the conviction I traded my system like a business. And by leaving that position in, then when it started breaking, it was very smooth sailing, it was there pretty quick. But I started adding to my order on the smaller time frames as it was swinging up and down. So as it broke new highs, I'd take more positions in, and then I'd obviously scale using profits that I had in the market. So these long-term trades, sometimes they can be very, very good. But what is cool about it is that I had the conviction to stay in the trade. So very difficult for a lot of people to stay in this long, and I totally understand it. But once you get your system down, you're going to be very, very happy with it, and you're going to stick to the rules. So starting on the 1 hour, 4 hour daily is a great way to be, because you're never going to usually be in a trade on the 4 hour or 1 hour chart for much longer than a few days. And if you're only in there for a few days, it's not such a big weight. And of course that makes you know, your mental or psychology a lot stronger, and then you can build yourself up to longer time frames. And usually you have a few accounts. You might have 2 accounts, let's say, that are open with Pepperstone. One's your long trade strategy, one's your short trade strategy. And that stops you from looking at it every day and making the mistakes that most people do, which is to look at it and then close them early or lack the confidence in their trades. We'll just jump back into the slides for a second. And what we're going to look at is we're just going to look at a simple kind of strategy that we could use when looking at multi-time frame analysis. So if we're building a strategy, obviously we talk about price action a lot. That's because that's actually what the market's doing. We love support resistance because that's the psychology of the market. And while past information obviously doesn't predict future events, what it does is it helps us get a bias for areas. And I can tell you that all of the big traders out there definitely use support resistance. They absolutely do. It's very, very important. Then we look at things like trending markets. So obviously if a market's trending, very, very important. We love trending markets. You'll find that if you follow trending markets, you'll actually be more profitable than if you try to counter trend. Counter trending or trying to fight the market is the mistake that I made many years ago. And I did it because I guess I felt that I was better than the market, or I knew something that other people didn't. But when I started to follow and I looked at those bigger time frames, and then I built my swing systems on the 4 hour and stuff like that, that really changed the way that we approach the market and made me a lot more profitable. Then you've got the pattern analysis, very, very important. Indicators. Now I've just given indicators 25 points. Generally, and I think we talked about this when we were doing MACD a few weeks ago, and if you haven't seen it, go check that video out. We talked about the fact that a lot of indicators all agree with each other. So once you've found one of the main indicators, and this isn't MACD, but things like stochastic RSI, those kind of ones, if you have one of those that's saying something, generally a lot of the others will say it. So check out that video because we suggest a few of our favorite indicators. And I think it's important just to use a few of them. And then of course, confirmation candle. I can't stress it enough, confirming your trade is key. So we always want to confirm the candles. We want to look for things like engulfing candles. We want to look for clear closes. If we're looking at a particular currency trade, let's say we're looking at this US dollar yen trade, what we're really going to be looking for so that we absolutely do not make any mistakes is this candle break here. So when this particular candle broke here, the reason why that's so important is because that's when it's clearly defined in time that this pennant is most likely going to look like this, and it's not going to look like something else later on. Now, this is where I'd first enter, and then of course the break of the new high is definitely where you would add to your position if that was part of your plan, and then the break of that high is where you'd add again. So it's important to wait for confirmation always, just like breaks of support. Never get in just going, oh, I think it's going to break here, I think it's going to break past this low, I'm scared, I'm going to get out, or I'm going to get in. Always wait till the close happens and you'll have a lot more success. Just like over here, if we waited for the close and then waited for the retest to this point here, you would have got in at a better pip. And over the last couple of weeks, might not sound like a lot, but there's 300 points here that you could have, potentially had on the smaller time frames by looking at the daily, weekly. So if we had our support, which is around here, I'll go to the close. And we had our resistance points. When it breaks past this support here, it comes back up and it retests it. If it does go too far, often it'll come back and it will retest this point. And when that happens, then you can get into the market and, of course, look for the sell side. So confirmation candles, or confirmation in general, is incredibly important. We always should be looking at it. And then we enhance our strategy. We basically bring all of these points together. We need at least 3 of them to get our 75 points, and then we can place our trade. So that's really when we can make the decision to get into the trade. Talk about it quickly. Risk management, obviously incredibly important. Always risk around 1 to 2% of your account. Do not risk any more than that, especially when you're first starting. I suggest to some people even risk less. Get your confidence, get your convictions, and then once you start to see that you're being profitable and you're having success, you can scale up your percentages over time. We always talk about this other one too. Do not basket trades. That means trading multiple yen or US dollar pairs, specifically yens. If you're trading the euro, the pound yen, the US dollar yen, and the odd yen, then you really are taking more than your fair share of risk. So if you've got 1% on each one of those, you're realistically taking 4% on that particular pair. And then, of course, last one is follow the strategy, follow the system, follow your business plans. So hopefully that helps a little bit with multi-time frame analysis. If you're somebody that trades on the 1 hour, 30 minute, 15, the same kind of thing can apply. What I always like to do though is I still like to look at, let's say, the 4 hour first. I will usually gain an idea of what's happening with the trend. So let's say if we were looking at US dollar yen, at least on the 4 hour, it's broken through here, but it's pretty range boundy. So we might be looking at shorts in this area here, longs in this area here potentially, and we wouldn't be going for too heavy take profits. So if we were buying here, we'd probably consider taking some of our trade off at the 107. Then we'd jump into the 1 hour, and then we'd start to actually analyze it and make some decisions whether we want to be in these trades or not. So hopefully that helps everybody. Josh, do we have any questions for tonight?
Yeah, we actually have a couple. I'll rattle them off now. They're actually quite good. First question that we have is it best to look at a larger time frame before trading technicals on a small time frame to see what the overall trend is doing?
Definitely. As I said, usually if you're trading a 1 hour, try not to look maybe too far up. So if you're trading a 1 hour, you can look at a daily trend, but you probably want to look at just the one above. So you get your bias on, let's say, the weekly, monthly, just in terms of those massive trade lines. So we'll just jump onto that euro again quickly here. So we had those massive trade lines in terms of supports and resistances. But then when we're looking at the hour chart, all we're going to be doing is we're just going to have maybe these massive trade lines in a different color, and we're going to really be focusing on the time frame above, which will be the 4 hour. And we're going to be looking for that one to give us a bias for the type of trend we want to be trading.
Thank you. And another question is, what if you are reading the trend correctly on a time frame, but a sudden change occurs when you are in a trade? What do you do to make sure you don't lose too much money?
Okay, so number one, you should always have your stop level put in. Another mistake I see commonly with people that we coach and look and help, often they come to us and they don't have stop losses. When you're placing a trade, you should have a clear idea of where your stop loss needs to be and a clear idea of where at least your first take profit needs to be. And then, of course, you might scale out of the trade. So let's say we're looking at this particular currency pair, the euro. If we were taking a longer term approach trade here, and we were waiting for a break of this high, when that high breaks, unless there's a little swing in between, what we're going to be looking for is we're going to be looking for either placing a stop underneath this swing here. So let's just draw this so I can show you what it's going to do. So let's say it does that and it starts breaking. We might get in at this point here because it's broken to a new high. We'd have to place our stop at least here or below these points here if it is more conservative. It may seem like a lot, but that's the kind of trade we're looking for. We have to place it. Usually the market will tell us. So never use 50 pips, never use 100 pips. Big mistake. Always use what is the market telling you. Where is the last swing of the market? Place it below that swing.
Okay, we've got just two more here. So for long-term trades, you don't actually care much about news events that are occurring?
No, super long-term trades, you don't really need to care too much. It's a lot of noise. Usually there's not too many actually huge events that happen. I think, you know, it's if you go back through time and you really consider, well, the Brexit obviously was a big event, but how many of those are there a year? There's a lot of news out and not much of it affects the market heavily. So generally, you can stick with the trade, and often these news events actually adhere to what's going on in the market. So if we look at things like the Brexit, well, what was happening on the long-term time frames of the pound US dollar? Well, last time I checked, this looks like a pretty big downtrend. So it was already in a downtrend. Often news will actually help you. And that's the thing about it. Yeah, when you trade the big ones, often the news helps you. I don't know the statistic, but I gather it's going to be more than 50% helpful. Yeah.
And last one here would be, what do you reckon is the easiest combination of timeframes to use with each other? As an example, daily plus 4 hourly, 4 hourly plus daily. What do you believe is the easiest to read?
Yeah, daily for trading, 4 hour for swing trading, 1 hour for entry. Yeah, definitely, especially in Forex. Very fast market. They're the best time frames because you're not going to get your proper stops when you start looking for the market to show you where the stops need to be behind the swings are generally going to hold the news events that happen through the day. So they're going to hold a lot of that CPI, GDP, those kind of news events. They won't stop you out. And it means that you can also build it into your work-life balance. So one thing I know that, you know, when I first started trading, I actually quit my job and I just went, you know, I made a lot and I thought, yeah, this is great and I'm going to get into it and do it. That is not a cool idea. So try not to do that because then you actually force yourself to make money. So what I think is best is that you always should stick to the idea of using the 4 hour daily because you can do that, you can work, you don't have to look at the charts very much. Remember, chart time doesn't mean you have to sit there watching your trade once it's made. When you make that trade plan, you should kind of live and die by that trade. Keep the trade in. Don't try to close it early or make changes to it because really what you're doing is you're failing your business plan or you're failing your trading system. So if you're the kind of person that is taking it out early, I would suggest that what you do is you basically break down your system to smaller trades and maybe if you want to keep the one lot or whatever you're trading, trade a 0.1 or a 0.05 or whatever in another account, leave your trading system in and compare the results. See whether the results are actually better when you stick to your system rather than when you modify the system, if you know what I'm saying. Yeah, definitely. But 4 hour, 1 hour daily.
Fantastic. Appreciate it.
Cool. Well, if that's all of the questions for today, thanks very much for bearing with me. Probably spoke a little bit too quickly because obviously I'm the only one here today, but I look forward to getting back on board with Tyrone next time for our advanced scalping strategies. I hope you guys can all attend it. And I'd also just like to let a few people know because we had some interest. We have launched our new website with the new course. So it's really good. Spent a lot of time on that. If anyone's interested, you feel free to check out at fxevolution.com. And we go into a lot of these kind of strategies, but in a lot more depth. And we really break it down for everybody to cut out all of the, I guess, garble and make it very, very clear. So hope you guys enjoyed, and we'll see you on the next Learn It Live.
Thank you.